Welcome to Christian Financial Perspectives, where you're invited to gain insight, wisdom, and knowledge about how Christians integrate their faith, life, and finances with a biblical worldview. Here's your host, Christian investment advisor, financial planner, and coach, Bob Barber.
Hi, Shawn.
Morning, Bob.
I tell you what.
Well, depending on when someone's listening, right?
That's true. It could be nighttime, right?
Yeah.
We have had a real bear market this year.
Yeah.
The market it dropped the most in the first 3 weeks of January.
Yeah.
If you look at the average, if you look at a growth or a moderate portfolio, it dropped about 7% in the first 3 weeks, and then it's dropped another 5 or 6%. Most of your indexes or moderate indexes since then. Of course, if you're in growth or aggressive growth, you've dropped a lot more.
Yeah.
And today we're going to continue in our series about how to handle these bear markets. You know, the last few episodes that we did, we talked about a Christian's response, how Christians should respond, and then investing during turbulent times.
And so for today, we've got questions for a down market or down markets.
These are really good questions you need to ask yourself during a down market like this, because you don't want to let your emotions get involved. Emotions should not be a part of investing at all.
And that is hard. I mean, we want to make sure people either watching or listening don't think we just look at it as, we'll just remove emotions. Because obviously, we know as human beings,
we're emotional creatures.
We have emotions. Yeah. But in the interest of what we're talking about, you're right. You've got to do your best to set your emotions aside and look at the facts.
So today we're gonna have a discussion about questions to ask during a down market. You know, we had this in our last special bear market newsletter, which is on our website at ChristianFinancialAdvisors.com. That's all you got to do. Christian Financial Advisors. If you want to abbreviate the financial advisors, you can go ChristianFA.com.
That's right.
And go to the newsletter area, the educational under articles, and that will get you to the part that we're going to cover today. But it really is good to hear it through video, because we're going to be discussing these questions.
Right. You know what's interesting too, Bob, is obviously there's a lot of signs that you can look at to see if we're in a bear market, such as, are the markets down? But you know what I always find interesting is, we know we're definitely getting into a bear market when all of a sudden our clients start contacting us without us having to reach out to them.
That's the truth, isn't it? Isn't it? During the up market, we're reaching out for account reviews and updates, and like,
and if we get a response, people are like, I'm good.
I don't need to talk to you. Well, today they want to talk with us.
Yeah. That's our first sign.
You know, one of the things I want to say before we get to these questions is the only guarantee in the stock market. There is a guarantee.
That you will have ups and downs.
You will have ups and downs, exactly.
And sometimes sideways.
I remember when we had Sal that worked for us many, many years ago, and you'd ask him, so what's the stock market going to do? And he'd always say, well, it's going to go up and it's going to go down. And I like that. He always had a real dry sense of humor that I loved. And, you know, this is true with anything that has a value. I mean, you look at real estate, bonds, precious metals like gold and silver, commodities, any kind of collectible.
Yeah.
The one thing about
it's not just the stock market.
But the one thing about the stock market is you're getting an appraisal every second of the day.
Yeah.
I was talking with a
That's
client.
An interesting way to look at it.
Well, you think about real estate. Unless you go get an appraisal every single day or every week, which you couldn't do, you really don't understand when the value of that real estate is dropping, which right now people don't understand. It is dropping because of the interest rate increases. And I would invite you to go back and listen to the program we made. Was it last year we made that? Or
I think
it was about investing in real estate right now, and should you, and because we covered the interest rates.
It's been within the last 6 months. I know that.
And it was amazing to me that the things we were predicting are now happening with the interest rates going up.
Well, the craziest part was, you had talked about the math of what if interest rates go from an average of 3% to 4%, and yet we've gone from 3% to almost 6%.
Yeah.
And now the analysts are predicting, I mean, we're within the next year or two, I mean, we're talking about easily being at 7%.
You think
as a norm.
You think the stock market's dropping. You look at the purchasing power of the average person that buys a home, which I looked at. The National Association of Realtors just came out with an article about 2 weeks ago that said that 87% of the buyers in the last 2 years have financed. 87%.
Wow.
Okay, so that's 87% of your market now has purchasing power that's half of what it was. So let's get into the questions.
Yeah.
All right, so we got 7 questions that we're going to be talking about, and I think this first question is really important when you're thinking about when you're in a bear market and how you're invested.
When you're in that downward trend.
Right, and I believe that everybody should have a diversified portfolio. So the question you got to ask yourself is, if you have a diversified portfolio, are you going to need all of it in the next 1 to 3 years? And why do I say 1 to 3 years?
So what you're saying is, are you going to need to effectively withdraw and actually spend all of that money in the portfolio over the next 1 to 3 years?
Exactly.
Okay. So I'm assuming you're saying that 1 to 3 years because of the time that typically it takes for us to get through a bear market.
That's
Since
correct.
The average bear market is over the last 73 years.
It's
the average bear
about
market's 11 to 12 months.
11 to 13 months to be exact.
Yeah.
Okay. So people get panicky when the markets drop over a 4 or 5 or 6 month period. Mm-hmm. But if they have a diversified portfolio, what I mean by diversified, if they've got bonds and then they've got stocks and then they've got cash and then they've got real estate and they're diversified over a lot of different things, unless you need all of that in the next average bear market of 11 to 13 months, and sometimes bear markets can go 2 or 3 years, but unless you need all of that, there's really no reason to panic, because you can pull from, usually there's a side that you can pull from that is not down while you're waiting for the other side to come up.
Right.
So if you have your bonds and then you have your cash and you have your stocks, just don't touch the stock part of the diversified portfolio. Now, if you're in 100% stocks and the stock market's down and you're needing money, you're diversified wrong.
That is absolutely correct.
That is not a good plan. But that's a strong first question.
Yep.
And I'm at peace about this because I'm very diversified. I've got enough easily the last 1 to 3 years.
Right.
And
as far as your income needs to take off of that, right?
Exactly.
So you practice what you preach, Bob?
I do, and that takes us just to the second question: do you have enough in cash and bonds to live on while waiting for the rebound portion of your stock portfolio to come back?
Gotcha.
And it helps with some, if you have a balanced portfolio, you'll see that whole thing down. Sometimes it helps, and you've seen me do this. Is that we will separate that portfolio.
Right. Create a second account. If there isn't already an account that we can move it to, but create a separate account that is the same kind. So if you have an IRA, we have another IRA. And that way our clients can easily see, okay, account number 1, 2, 3, 4 is our stock portion. And account number 1, 2, 3, 5 is our bonds and our cash.
So you separate it completely out. Because within a balanced or a moderate portfolio, you've got a part of it that is stocks and a part of it that is bonds and fixed income.
Right.
So when you see when you see it going down, you're thinking it's all going down.
Right. It's a little harder to separate that out and see, okay, well, how have the bonds, the fixed income, the cash, how have they been doing versus the stock portion when it's in that one account? And
while interest rates have risen, while we've had some downturn in bonds, it's been nothing like stocks.
Oh, right.
Yeah. 3 or 4%, nothing like the 15, 20. I mean, you'll see some of these stocks come out and they'll be down 25% in one day. And a lot of that has happened.
There was that streaming service that has a red letter and a black background, usually, not going to mention any names, that has dropped a little bit over the last 6 months. Yeah. Like 50%.
A lot. Yeah. A whole lot. As we've coming out of the pandemic and people are not going to sit around and watch TV anymore, thank goodness.
Yep. And there's a lot more competition. But anyway, that's different topic.
So first question, do you have a diversified portfolio? Second, do you have enough in cash and bonds? Third question.
Are you smart enough to perfectly time the market by getting out at the perfect time and getting back in at the perfect time?
How many times I say perfect in there?
Well, I think you're trying to drive a point.
Yeah. if you look at the charts, and we have a chart that we need to.
Yeah, we'll
here,
include the chart.
okay?
If you're listening, you'll have to go to our website to check it
to
out.
see
But
it.
if you're watching it, we'll put it up on screen. But you're talking about the chart over the last 70 plus years.
Well, I'm talking about the one that's in the last 15 to 20 years of where if you just miss the 3 to 5 days and how the returns in a all stock portfolio,
right?
How the returns in an all stock portfolio go from like an average of 10% down to 5% by missing just 5 to 10 of the up days, because the up days you never know when they're going to hit.
Yeah.
And then missing the next 5 to 10 of the up days, your return goes from 10 down to 1%.
Yeah.
So it's really important that you're there, because markets move fast, and what people will do is the markets will be down and they'll say, I want to get out, and then they'll say, well, I want to get back in after it's recovered, and you've missed those days.
Yeah, you've missed a huge percentage of the potential comeback.
Next question is, if you have a well-diversified portfolio, do you believe that people are going to quit using things like technology, healthcare, medicine, utilities, gas, transportation, food, shelter, clothing?
No.
I don't. Yeah, I mean, I'm still putting gas in my car, as expensive as it is right now.
Yeah, because we have to.
We're using technology right now to record, and we've got our Google apps here that we're getting, staying with our outline. We're using utilities. We got the lights on. Got our clothes on. Thank goodness.
Yep. That's a very different.
We got our drinks. I had a good breakfast this morning. That's the normal thing. The things that we use. If you're invested in those companies, do you believe they're just going to completely go away because it's a bear market? No.
And I guess what you got to, another way to look at that, yes, the stock price of those companies, it may have fluctuated, but are they going to go to zero? Are they going to completely go out of business, like for these like critical industries? No.
Yeah.
Like it's a bear market. You look at the bear market, you look at the bull markets. Your bull market lasts multiple years on average, typically, and your bear market lasts about a year. It's just math. It
We've
fluctuates.
said that one before.
We have. Yeah.
but this is so important to know in a down market like we're in, and in this bear market. And question number 5. Go ahead, Shawn.
Will I allow short-term thinking to get in the way of long-term success? That's a good one.
Need I say more?
Well, you can. I mean, we are describing the questions right now.
Well, it is. People get caught up in just the time, and for some reason,
the last 6 months, what's been going on,
or the last 3 months.
Yeah.
And I think it's different this time. And we talked about that a little bit on the last podcast video that we did. It's not different this time.
But yet everybody thinks that. Every single time there's been a downturn, people think it's different this time. And yet so far, 100% of the time, it's not been different this time.
What?
I mean,
I like that. 100% of the time,
it's been a few years since Solomon said it originally, but he did say at one point in the Bible that there's nothing new under the sun. So if he said it however many thousands of years ago, it's still true.
I'm so glad one of our clients they listened to the podcast, because they said that yesterday. There's nothing new under the sun. I'm not worried about it right now. And also they said I'm not watching the news all day long.
Yeah.
I'm living a life.
Well, especially most of your major news, it's not news. Like, I mean,
It's
they have the word news in it, but if you look at them, they're entertainment companies.
Yeah, that's right.
Their goal isn't to accurately portray what's going on or what you should or shouldn't be scared about. They want to get you to come back after the commercial break. They want to get you to tune in and freak out and buy the supplements.
I noticed another thing from watching the entertainment channels for so long, the new entertainment news channels, especially, I'm not going to name the channel, but it's the major financial channel, okay? They have this little bank of bear advisors and bull advisors. And when the bear market's happening, they go get all their guys. It's doomsday. It's the end of time. And they play on those emotions. And then when the market starts to turn back, they'll go get their bull advisors. Their advisors that are positive. So they have their negative and their positive. And it's amazing how they play that game.
Yeah,
they do it over.
Well, if the markets are going down, let's bring our negative Nellies on. Let's bring the bear market guys on. And then vice versa. If it's going up, it's going to go nothing but up from here. And
it's always the market plunged or the market skyrocketed.
Yeah.
It plunged. It went down 4% or it went down 3% or 2%. Plunge would sound like you're off the cliff. When the markets are down, this is question number 6, and this is my number one thing.
Yep.
Number one, when the markets are down, I look at it as a buying opportunity instead of a selling one.
Yep.
Shawn, it amazes me that over and over, everybody wants to buy everything on sale. If you go to Walmart or Target or Costco or Sam's Club or wherever, you want to buy it when it's on sale, right?
Yeah.
Like the day after Thanksgiving, everybody wants to buy everything on sale.
Yeah, when you see all those clearance signs, or 25% discount, or buy 3 get 1 free. You have all this stuff that's like, it's a great deal. Look at how much money I saved. But yet, I have a feeling you're saying when it gets in the stock market, people do the exact opposite. They want to buy low.
Yeah.
They want to sell high, and yet the majority of investors, consumers, they end up doing the opposite.
They buy high.
Yep.
And they sell low.
And they sell low in the panic.
Exactly the opposite. So look at this right now during a bear market as
a buying opportunity.
So
if you do have capital set aside, you do have something that has been more conservative, if anything, just start dollar cost averaging into the equities, into the market, because the more you do that now, the more of a buying opportunity you have.
And do we know we're at a bottom? No, we don't. We can't predict anything here.
No. But it's already, just look at the last 6 months or so. Just compared to the last 6 months, how much of a discount are we already at in general?
Yeah.
Everything's
at a discount.
Yeah, you might get a little bit more of a discount, but you don't need to wait for the Memorial Day sale. It's already 20% off or 30% off.
And which takes us to our last question of the day.
Do great investors like Warren Buffett go with the crowd and run away from the markets when they're correcting, or buy stocks at lower prices? And I guess he would be considered probably the most famous person to date as far as what's considered a contrarian investor, which is exactly what you were talking about on question number 6, where when the majority of people think it's going to go nowhere but up from here, that's when a contrarian investor says, I should probably sell off some of my positions. Because if everybody thinks it's going nowhere but up,
right,
it's probably about to have a correction.
When everybody wants to buy, sell, when everybody wants to sell,
and now
buy.
Everybody's panicking. Everybody thinks it's, you've got all the bear analysts that are coming onto the news channels and talking about how it's going to just continue to plunge from here. Okay, well, that's a good indication that even if you don't move everything in, maybe you should start making some purchases, each month and start moving in, because it's already at a discount and you go against what most people are doing.
The thing, as we're at the end of today's video podcast, one of the things I like to do is, we've been going out to eat a lot lately because of the pent-up demand from COVID. Yeah. I've noticed every restaurant's full to the brink. As we're making this, it's right before Memorial Day, and they were saying that the airports are just packed. It doesn't look like we're in a recession.
No, not really.
So while they may say that, and they love to talk about that, look around. Are people still driving their cars? Are they still going out to eat? Are they still going to the grocery store? Are they still using technology?
Are you getting stuck in traffic on your way to work and back, or going to the movie or restaurant? Whatever. Yeah,
exactly. So I hope this has helped you about questions to ask during a bear market, and if you have any questions, we'd love to answer them.
Yeah, well, the Lord doesn't give us a spirit of fear, but
of sound mind.
He gives us one of sound mind. Yeah.
That's right. So you can call or text us at 830-609-6986 during business hours.
And you can check out our podcast episodes on our website at christianfinancialpodcast.com, or you can search for Christian Financial Perspectives. Thank you, and God bless.
We invite you to listen to all of our past episodes covering many financial topics from a Christian perspective. To make sure you don't miss any of Bob's upcoming episodes, you can subscribe to Christian Financial Perspectives on iTunes, Google Podcasts, Spotify, Stitcher, or Amazon Music. To learn more about integrating your faith with your finances, visit ChristianFinancialAdvisors.com or call 830-609-6986. Investment advisory services offered through Christian Investment Advisors, Inc., DBA Christian Financial Advisors, also known as Christian Financial Advisors Management Group, a registered investment advisor. Comments from today's show are for informational purposes only and not to be considered investment advice or recommendations to buy or sell any company that may have been mentioned or discussed. The opinions expressed are solely those of the host, Bob Barber, and his guests. Bob does not provide tax advice and encourages you to seek guidance from a tax professional. While Christian Investment Advisors believes the information to be accurate and reliable, we do not claim or have responsibility for its completeness, accuracy, or reliability.